Here's a fact that should keep you up at night. In September 2006, the IMF's World Economic Outlook calmly declared that global financial risks were broadly balanced. 18 months later, the entire world financial system was on the brink of collapse. We like to believe crises announce themselves, that smart people in suits will spot the cliff and hit the brakes. History says otherwise. They never do, because the next big collapse isn't hiding in some obvious failing bank or crashing stock market. It's baked into the very architecture of the system itself, a mechanism so deeply embedded that even the people running it don't fully understand what they've built. And the most disturbing part, the system has already started cracking. You just can't see the fractures yet. By the end of this, you will. Back in 1954, a young economist named Hyman Minsky sat in a Harvard lecture hall. He was listening to Joseph Schumpeter explain how capitalism thrives on cycles of creation and destruction. Minsky left that lecture obsessed with one unsettling question. What if stability itself is the real danger? It sounds like a paradox. Stability should be good jobs, growth, rising markets, confidence. But Minsky studied cycle after cycle and reached a chilling conclusion: the financial instability hypothesis. Here's how it works. During long periods of calm, people stop being afraid. And when fear disappears, they do something dangerous. They borrow. At first, it's cautious and rational. Businesses borrow to expand because revenues comfortably cover the payments. Banks lend freely because defaults are low. Investors pile into assets because prices have risen for years. It feels safe to assume they'll keep rising. Everyone is behaving sensibly according to the environment they're in. But beneath the surface, something sinister is happening. Every year of stability makes debt cheaper, lending looser, and collateral requirements weaker. Slowly, silently, the system shifts. Minsky called these stages hedge finance. Income covers both interest and principal. Speculative finance. Income covers only interest. Ponzi finance borrowers need rising asset prices just to stay afloat. Nobody rings a bell when the shift occurs. There is no warning. The entire financial system drifts from safe to dangerously fragile, while everyone congratulates themselves on how stable everything looks. Minsky died in 1996, largely ignored. Then 2008 happened. Suddenly, every economist was quoting him. The term Minsky moment entered the dictionary. That sudden point when debt-fueled euphoria flips into panic. Assets are dumped, and the whole artificial structure collapses. But the real lesson wasn't the crash. It was the dangerous stability that came before it. And here's what should terrify you right now. We have just lived through one of the longest artificial stability periods in modern history. From 2009 to 2022, interest rates were pinned near zero across the developed world. During that time, global debt exploded from roughly $200 trillion to over $315 trillion. That wasn't coincidence. That was Minsky's hypothesis playing out in real time on a planetary scale. Ludwig von Mises had a name for this final phase. The crack-up boom, an explosion of borrowing and asset inflation. That looks like prosperity until the moment it doesn't. So the question isn't whether the Minsky cycle is running. It is. The question is, where exactly are we in it? To understand the real danger, we need to look at a mechanism almost no one is naming clearly. The modern doom loop. Let's go back to May 1931. A mid-sized Austrian bank called Creditanstalt released disappointing numbers. Wheat and Weeks Bank runs swept to Austria, then Germany, then Britain. The Bank of England was forced off the gold standard. Credit markets froze. What had been a bad recession became the Great Depression. One mid-sized bank in a country most people couldn't find on a map helped end an era. Why? Because everything was connected. Banks held government bonds. Governments owned stakes in banks. Insurance companies held both. When one piece cracked, the whole web trembled. Today's doom loop is far larger, more complex, and better hidden. Here's how it works. Now, banking regulations like Basel III require banks to hold high-quality liquid assets, mainly government bonds, US treasuries, European sovereign debt, Japanese government bonds. These are supposedly the safest assets on Earth. So banks buy massive amounts of sovereign debt. Your bank deposits are literally helping governments borrow. Now flip it. Governments, drowning in record debt, the US at $36 trillion and climbing, Japan over 250% debt to GDP. The UK at levels not seen since the Napoleonic Wars. Can only keep borrowing cheaply because banks are essentially forced to buy their bonds. The banks prop up the government's backstop. The banks neither can fail without destroying the other. Now, add inflation. When inflation rises, central banks raise interest rates. Higher rates make existing bonds issued at low rates crash in value. Suddenly, banks holding these safe assets discover giant holes in their balance sheets. This isn't theory. In March 2023, Silicon Valley Bank collapsed almost exactly this way. Long-duration treasuries lost so much value that, when depositors wanted their money, the bank evaporated in 48 hours. SVB was small. The real problem is that similar unrealized losses sit quietly on balance sheets across the global banking system. Estimates range from $500 billion to over $2 trillion. And the doom loop doesn't stop with banks and governments. There's a third player that has grown enormous: private credit. Non-bank lending outside all traditional regulation. In 2015, the private credit market was about $500 billion. By early 2026, it has surged past $2.1 trillion. These funds have no deposit insurance, no lender of last resort. When they get in trouble, they simply stop lending. Companies that rely on them for refinancing suddenly face an existential crisis. Commercial real estate is the clearest pressure point. Over $1.5 trillion in CRE debt is maturing or needs refinancing. Between 2024 and 2026, much of it was written at 3%. Refinancing today means 7 to 9%. The math doesn't work. Defaults are accelerating. But remember Minsky. The defaults aren't the crisis. The crisis is everything they're connected to. Ray Dalio spent decades studying why empires rise and fall. His conclusion: every major power runs on a long-term debt cycle of roughly 75 to 100 years. We are now deep inside one. The last time America hit the end of such a cycle was 1929 to 1945. The debt structure broke, the banking system failed, and a global war helped reset the order. That was about 80 years ago. Today, the warning signs are flashing. The US government now spends more on interest payments than on national defense, over $1 trillion a year. That's not politics. That's mathematics, screaming. Irving Fisher, one of the most respected economists of his time, declared in September 1929 that stock prices had reached a permanently high plateau. 9 days later, the market crashed. He had measured stability and extrapolated it forward, completely missing the fragility underneath. We're making the same mistake again. Corporate debt in the US has doubled since 2008. 15 to 20% of publicly traded companies are zombies. They can't even cover interest payments from operations and survive only by rolling over more debt. Pure Ponzi stage. And here's the final, uniquely dangerous piece. Modern portfolios are built on one core assumption: different assets behave differently. Stocks fall, bonds rise, inflation spikes, gold protects. When the economy slows, cash is king. In 2022, that assumption shattered. Stocks fell 20%. Bonds fell 15%. At the same time, the classic 60/40th portfolio had its worst year since 1932. Everything moved together downward. This is called correlation convergence. When the shock is big enough, diversification disappears. Every asset, inflated by the same cheap money, now falls with the same tide. The 2022 episode was a warning shot, even with the Fed carefully telegraphing every move. What happens when the next shock comes from an unexpected corner, without warning? A private credit fund freezing redemptions, a regional bank failure in Asia. A sovereign debt crisis that proves more contagious than anyone expected. The cascade will be faster than any institution can respond. The Federal Reserve's policy space is far narrower than in 2008. Rates can't realistically go back to zero without reigniting inflation that worsens the doom loop. The debt burden is 3 times larger. We are staring at what Nouriel Roubini calls a stagflationary debt crisis. High inflation, high debt, and low growth colliding at once. Michael Burry has been warning that the explosion of passive index investing has created the illusion of diversification while actually concentrating risk. When panic hits, everyone sells everything proportionally. The Minsky stability trap has been running for 15 years. The doom loop between banks, governments, and private credit has grown too big to backstop. The long-term debt cycle is showing every late-stage symptom, and the diversification most people rely on will fail them precisely when they need it most. The crisis won't announce itself with trumpets. It never does. It will start in some obscure corner you've never heard of, and by the time the headlines hit your phone, the window to act will already be closing. History shows that the survivors weren't the ones who perfectly timed the crash. They were the ones who understood the architecture well enough to see which pieces were truly load-bearing. You now know what those pieces are. Don't forget what real money and real stability look like. The patient has a fever. They just haven't checked the thermometer yet.